So when you think about a constraint, from a perspective of the revenue recognition, so an entity should include an amount of variable consideration. They remember the example of this construction, 25 crore is 25 crore is what I'm going to do, the contract consideration. And then I have this 2.13 for my early completion and 2 crores for my bonus. So that's the variable consideration, right? In the transaction price, only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. Now, important is an entity should include an amount of variable consideration in the transaction price only to the extent that it is highly probable, not probable, highly probable, okay, that a significant reversal in the amount of cumulative revenue recognized and will not occur when the uncertainty associated with the variable cost is subsequently resolved, right? Now, I think it is important for you to understand some of this. So when I say possible, okay, when the accounting standards say possible, what does this mean? It means that less than likely. Okay, when we say probable, what does this mean? More likely than not. Okay, and when we say highly probable, okay, what does that mean? Highly probable, likely to occur. So in percentage terms, this is like somewhere between 30% to 50%, right? This is more than 50%, okay? And it is something which is more than this, I would say, 70% plus in a way to 95%. If I go beyond 95%, that's like certain. So when you think about probability, right, you're remote. When something is being called as remote, which is less than in a way 30, 25, 30% or a 20% scenario. It is possible means 30 to 50%. If it is probable means more than 50%. Highly probable means 70 to 90, 95% scenarios is what we are talking. The degree of comfort is if it's certain, then virtually certain, if it is virtually certain, like more than 95%. If it is certain, right, that means 100%, so to say. So there are all kinds of scenarios, and then of course it's an exercise in judgment is what you need to look at. But from a constraint perspective, that do I need to consider this variable consideration as part of my contract consideration at this point in time or not? You got to cross a higher hurdle, right? The hurdle is not probable, hurdle is highly probable, right? So your degree of confidence in terms of realization of this revenue should be that it is highly probable that the reversal is not likely to occur, as these contracts unfold. From that perspective, what's the objective of the constraint? Is include variable consideration only to the extent that it is highly probable that a significant revenue reversal will not occur. Significant is relative to the cumulative amount of revenue which has been recognized. And what are the indication? In a way, consideration is highly susceptible to factor outside an entity's influence. Uncertainty of variable amount is not expected to be resolved for a long period of time. Entity expected experience with similar contract is limited or has little predictive value. Entity has a practice of offering price concession or changing payment terms. And so if you look at some of these criterias, right, what are we trying to say? If you have these features or these type of revenue arrangement, or that's your, in a way, fact pattern, in a way, it says that your ability to predict is far lower. Your degree of confidence is far lower in a way if the event is not in your control, linked to a weather, linked to an external market factor or a market volatility. It's not likely to get resolved over a long period of time. You're not able to do this appropriately in the past, so on and so forth. So you got to, again, it's an element of judgment. You got to appropriately evaluate to your facts and circumstances and then apply this constraint, which is supposedly a high hurdle of highly probable, which is understood as likely to occur. Likely to occur means like 70 to 90% possible range is what you are in terms of your degree of confidence of realization of this variable consideration from your customer for we to conclude that it should be considered as part of revenue recognition today, so that there is no likely reversal in the future period. Because if there's a reversal, that's not a good answer, right? That's not a good answer. So let's look at example in the context of a volume discount, right? So HT Limited enters into a contract with a customer on 1st of April to sell products to X for INR 1000 rupees per unit. Okay, 1000 rupees per unit. If the customer purchases more than 100 units of product A in a financial year, the contract specifies that the price per unit is retrospectively reduced to INR 900 per unit. Okay. Consequently, so if you were to buy 100 unit, okay, then there is a reduction to 900. That's a retrospective, in a way, reduction. I'm going to, it's like a volume discount. Okay. Now, for the first quarter ended 30th June, the entity sells 10 units of product A to the customer. The entity estimates that the customer purchase will not exceed the 100 unit threshold for the volume discount in the financial year. That means what I promised, a discount is not likely to be triggered. HT Limited determines that it has significant experience with this product and with the purchasing pattern of the customers, of a high degree of confidence in my ability to assess that whether this customer is likely to meet the threshold or not. So if it is, again, I'm reasonably confident, like highly probable scenario, thus HT Limited concludes that it is highly probable that a significant reversal in the cumulative amount of revenue, which is what, 1000 per unit, 10 unit are sold. So 1000 per unit will not occur when the uncertainty is resolved, right? When the total amount of purchase is known, because it's, let's say, 1 year target. So how much we said it is 1000 per unit, right? Then I had 100 unit target. If you look at, and then I said you are entitled for a discount of 10%, right? In a way which we will reduce to 10% discount. When you will get discount if you were to meet 100, but I don't believe how much you've done, 10 units, right? And I don't believe that you will be able to meet 100 units target, and that's my highly probable estimate, right, based on my experience, right? So what do I do from a revenue recognition perspective? I will make that evaluation. Let's add some more fact pattern. Now, in May of 2001, the customer acquires another company, and in the second quarter ended 30th September, the entity sells an additional 50 unit of product A to the customer, right? In light of the new fact, the entity estimates that the customer purchases will exceed the 100 unit threshold for the financial year, and therefore it will be required to retrospectively reduce the price per unit to INR 100. INR 900. Determine the amount of revenue to be recognized by HT Limited for the quarter ended 30th June 2001 and for 30th September 2001, right? So in a way, I purchased an entity in another company, and in the second quarter, I sold now 50 unit. So there is some more facts which is evolving here. And now, based on my experience and acquisition, now I believe that possibly, we may exceed, right? So the whole question is, how do I deal with this from a quarter to quarter perspective? Okay. Now, when I was doing it at the quarter one, right, I believe that there will be no discount because the triggers will not be met. So what happens in the quarter ended, I will record the full revenue, 10 units into 1000, which is 10,000. Okay. Now I move to quarter two. In the quarter two, now I see that I'm going to be, I'm likely to meet the discount, right? So I'll have to offer 100 rupees discount to each of the unit because the trigger is now likely to be met. So how many units I have already sold? I have sold 60 units. How much is the discount? It's a 6,000 discount. Now I need to accrue on a cumulative basis. So how much is going to be my revenue? Will be 44,000 for the quarter ended 30th September. Is so additional 50 units I'm going to sell, right? And then 10, so total 60,000. My YTD revenue is going to be total 60,000. 10,000 I have already recorded, so the balance is 44,000 is what I will end up recording, which is 54,000 for the sale of 600 units less the change in the transaction price. 10 into 100, for the reduction of revenue relating to units sold for the quarter ended June 30, 2001 as well. So if there is a change in estimate, all right, unless we believe that we made an error in the judgment in the past, the change in estimate is accounted on a prospective basis. You may have to do a cumulative catch up in the future period, but you don't revise the previously issued financial statement, right? From that perspective, and hence it's an important point for you to understand. Here, it's a change in estimate. If it's a change in estimate, you applied it on a prospective basis. Now here, because the discount is also applicable to the unit which has already been sold in the Q1, that is why even though you're applying on a prospective basis, you are doing a cumulative catch-up, right? And hence you accrue in a way a discount of 6,000 on this in Q2, because now you believe that that is my most likely realization under this contract. Now let's look at another example. If there's a management fee which is subject to a constraint, right? So here on April 1, 2001, an entity enters into a contract with a client to provide asset management services for 5 years. The entity receives a 2% quarterly management fee based on the client assets under management at the end of each quarter. 2% is what I'm entitled, right? At 31st March 2002, the entity asset under management are INR 100 crores. In addition, the entity receives a performance-based incentive fee of 20% of the fund return in excess of the return of an observable market index over the 5-year period. Consequently, both the management fee and the performance fee in the contract are variable consideration. Analyze the revenue to be recognized on 31st of March 2002. Okay, analyze the revenue to be recognized on 31st of March 2002. Okay, so what are the variability? If you see that whatever is going to be the asset under management, 100 crores, I'm entitled for how much percentage? I'm entitled for 2%, right? I'm entitled for 2% quarterly management fee, and entity receives a performance-based incentive fee of 20% of the fund return in excess of the return of an observable market index over the, so whatever the index has given, if you give more return than the index, you actually participate in the super profit, so to say, which is a hurdle rate. Hurdle is the index return, and then you get 20%, from that perspective. Consequently, both the management fee and the performance fee in the contract are variable consideration. You got to determine how much revenue I need to record, right? And that's where the whole analysis suggests that, because there is a continuous amount of variability over which you have an external market factor over which you have little or no control, in a way, so to say. So you got to record accrue revenue based on as you go. So today, if you believe 100 crore, you record 2%. Tomorrow it becomes 120. You record 2% on 120, and then if you actually, been able to earn the bonus, you're going to record bonus, as and when you comfortable that the bonus is being earned, from that perspective. So the entity accounts for the services as a single performance obligation, provide a series of distinct services, substantially the same and have the same pattern of transfer, blah, blah. That is time-based measure of progress at each reporting date. You will update the estimate of the transaction price. Entity concludes that it can include in transaction price the actual amount of the quarterly management fee because the uncertainty is resolved. On a quarter-on-quarter basis, the uncertainty is resolved. It also concludes that it cannot include estimate of the performance-based incentive because there are significant external factors over which I have no control. There's not been a change in assessment from the contract inception. The variability of the fee based on market index indicates the entity cannot conclude that it is highly probable that a significant reversal in the cumulative amount of revenue recognized would not occur if the entity concluded its estimate of the incentive fee in the transaction price. That means on 100 crore, how much is my revenue on an ongoing basis? Is 2 crore. So in the year end, when you get to the year end and when you see now all the factors are sorted to say, okay, index return was 10%, my return on portfolio was 20%. I've given extra 10% return. I'm now entitled for 20% share of that. So I'm going to record, another 4 crores, and that you only do, so to say, when this uncertainty is resolved, because then only it is becomes certain. So till the time actually it becomes certain, you're not able to demonstrate that you will be able to reach to a highly probable threshold where, with degree of confidence that there is no likelihood of a revenue reversal in the future period, right? And if that is not been achieved, you will not consider that variable consideration for the purpose of revenue recognition. Let's look at a scenario on right of return. Okay, so what is the right of return means? Let's say you buy goods from all these e-commerce sites, and they say if you don't like it, you can return it, right? And we know that not all of us are going to return it, right? So if there are 100 customers who have placed order, they know that 5 of them may return or 10 of them may return based on their data, understanding, analysis, type of product, range of customers, etc., etc. So the whole point is that if your policy allows that your customers can return the product, right? If they're allowed to return the product, then you have to also factor that as a possibility in determination of variable contract consideration, right? And again, we will try and understand this with the help of some examples. So right of return are also a form of variable consideration. Recognized revenue when is limited to the amount for which it is highly probable a significant reversal. That means it is highly probable that there will be no return from the customer standpoint perspective, right? If there's a refund liability, I need to accrue for the liability. I'm not supposed to record revenue, right? I need to accrue for the liability. And then the asset which I'm going to receive in return, right? That is akin to my inventory. But many times what happens is that the goods now which have been returned, they are opened, they may be spoiled, the another person who may want to buy it may not be willing to pay the full price, etc., etc. So you got to again determine, do I need to adjust the realizable value of the inventory which has now been returned? So depending upon your fact pattern, you're going to appropriately adjust that. From a recognition perspective, return asset must be recorded separately from inventory, may be disclosed separately as well, depending upon the materiality. They're also subject to impairment review, right? From that perspective. So let's just try and discuss this with the help of an example. So an entity enters into 1,000 contracts with customer. Each contract include the sale of one product for INR 50, right? There are 1,000 POs, for example, and then there are every contract value is 50. The total contract consideration is 1,000 into 50 is 50,000. Cash is received. when control of a product transfers, the entity customary business practice is to allow a customer to return any unused product within 30 days and receive a full refund. The entity cost of each product is INR 30, right? The entity cost of each product is INR 30, all right? The entity applies the requirement in Ind AS 115 to the portfolio of 1,000 contracts because it reasonably expects that in accordance with paragraph 4, the effects on the financial statement from applying these requirements to the portfolio would not differ materially from applying the requirement to the individual contracts within. So you're applying a portfolio approach here, right? Because in your judgment, you have large number of contracts, you have the ability to assess the customer in a way, demonstrate a similar type, size, pattern, behavior, so on and so forth, and hence you have the ability to make some of these estimates which are highly probable. So that since you allow a return of the product, the consideration received from the customer is variable. You receive 50, but I may have to actually give back this 50 if the product comes back. To estimate the variable consideration, to which the entity decides to use the expected value method, right? You have a range of possibilities, and you believe that it is method that entity expect to better predict the amount of consideration. Using the expected value method, the entity estimate the 970 products will not be returned. That means how many will return? So how many I sold? I've sold 1,000. How many are not going to be returned? 970. So how many are going to be returned is 30, right? From that perspective. So the question here is that the entity estimate the cost of recovering the product again will be immaterial. Determine the amount of revenue, refund liability, and the asset to be recognized by the entity for the said contract. We need to do all three, right? So how much is my revenue here? I've sold 1,000 products. What's the contract price? 50. Total contract consideration is 50,000. But how much I need to refund? I need to refund 30 into 50, right? 30 into 50 is how much? 1,500, right? This much is what I expect to return, right? So how much is this? 48,500. 48,500 is my revenue. How much is my refund liability? 1,500. How much is my asset, which I need to record? My cost of the asset is what? 30 rupees in this example, right? So if it is 30 rupees in this example, then I'm going to record, which is where is it, right? The entity customary business practice, blah blah. 1,000 reasonably expect individual, since the contract consideration is from the customer is variable. When entitled, the methodology using respect to 970 will not. It's a sort of profit, right? So how much is what I need to record? Let's look at this from a solutioning perspective. So the entity also consider the requirement in paragraph 56 to 58 of Ind AS 115 from a constraint perspective, and you record 48,500 as part of your transaction price. Is a 30-day return period. So 1,000 product, 30 is expected to be returned, right? A refund liability of 1,500 you're going to create, which is 50 into 30. An asset of INR 30 into 30 products, so right to recover product from the customer and settling the refund liability. So whatever is your value of the inventory is what you end up recording, right, as an asset from that perspective for you to evaluate it appropriately. All right.